Stephanie is 47 years old. She has been contributing to her 401k for 22 years. She checks her balance maybe once a year. Last month, she logged in and saw $312,000. She felt good. She is on track. Her company's 401k offers a target date fund, Vanguard Target Retirement 2040. The fund is designed for people retiring around 2040. Stephanie plans to retire at 67, which is 2043, so 2040 is close enough. The fund automatically adjusts the asset allocation as she gets closer to retirement. It starts aggressive with mostly stocks and gradually shifts to bonds and cash as the target date approaches. Stephanie does not have to do anything. The fund handles everything. Set it and forget it. She has been in this fund for 12 years. She just compared her returns to a coworker who has been in a simple S&P 500 index fund for the same period. The coworker has $361,000. Stephanie has $312,000. They have contributed the same amounts, same company, same match, same timeline. The coworker has $49,000 more. Stephanie cannot figure out why. They are both in index funds. They are both being responsible. The difference is the target date fund. Stephanie is in a fund that charges 0.75% annually in fees and holds 30% bonds, even though she is 20 years from retirement. The S&P 500 fund her coworker is in charges 0.04% annually and holds 100% stocks. The fee difference, 0.71% per year, does not sound like much. Over 12 years on growing balances, it cost Stephanie approximately $28,000. The bond allocation cost her another $21,000 in missed growth because bonds returned 4% while stocks returned 10% over the same period. Stephanie paid $49,000 for the convenience of a fund designed for her retirement date. She was being harvested. My name is Bobby, and I spent the last 4 months investigating why target date funds are the most expensive, mediocre investment option in most 401k plans, while being marketed as the smart default choice. If you were invested in a target date fund, if you chose it because it seemed simple and appropriate for your age, if you assumed a fund with your retirement year in the name was optimized for you, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. What I am about to show you is not whether target date funds are a scam in the legal sense. This is about how target date funds charge higher fees than simple index funds, shift to bonds too early, generate lower returns, and are designed to benefit fund companies and plan administrators more than they benefit you. The index fund myth is that all index funds are cheap and efficient. Target date funds are index funds. They are also expensive and inefficient compared to the alternative. You believe that target date funds are a safe, hands-off way to invest for retirement. You think that a fund designed for people retiring in 2040 is optimized for someone your age. You think the automatic rebalancing from stocks to bonds protects you from risk as you approach retirement. That is what the fund marketing says. That is what your 401k enrollment materials probably said when you signed up, and it is costing you tens of thousands of dollars compared to a basic S&P 500 index fund that you manage yourself with one rebalancing decision every decade. Stephanie is in the Vanguard Target Retirement 2040 fund. The expense ratio is 0.75%. That's 18 times more expensive than the Vanguard S&P 500 index fund, which charges 0.04%. Stephanie has $312,000 in her account. She is paying $2,340 this year in fees. Her coworker with $361,000 in the S&P 500 fund is paying $144 in fees. Stephanie is paying $2,196 more per year for a fund that has underperformed. She is paying extra to get worse results. Over the next 20 years until retirement, if both accounts grow to $1 million, Stephanie will pay $7,500 per year in fees. Her coworker will pay $400. The fee difference alone over 20 years is $142,000. Stephanie will retire with $142,000 less than her coworker because she chose the fund with her retirement year in the name instead of the fund with the lowest fees. The asset allocation is the second way target date funds destroy returns. Stephanie's fund is currently 70% stocks and 30% bonds. She's 47. She has 20 years until retirement. There is no reason to hold 30% bonds at 47 unless you are terrified of volatility. Bonds returned an average of 4.2% over the last 20 years. Stocks returned 9.8%. Every dollar Stephanie has in bonds is growing at less than half the rate it would grow in stocks. She has $93,600 in bonds right now. If that $93,600 were in stocks instead, and it grew at 9.8% for 20 years, it would become $630,000. In bonds, at 4.2%, it becomes $212,000. She is giving up $418,000 in growth by holding bonds she doesn't need yet. The target date fund is making her conservative 2 decades early because the fund company's liability concerns matter more than her returns. If the market crashes and she loses money, she might sue the fund company for being too aggressive. If the fund underperforms because it was too conservative, she has no legal recourse. The fund company protects itself by shifting to bonds earlier than necessary. Stephanie pays the cost. The glide path is the term for how target date funds shift from stocks to bonds as the target date approaches. Most target date funds use a glide path that assumes you will retire exactly on the target date and cash out all your money immediately. Stephanie's fund will be 50% bonds by 2040. She will be 61. She is not retiring at 61. She is retiring at 67. And she is not withdrawing all her money at 67. She is withdrawing 4% per year and leaving the rest invested for another 20 to 30 years. The fund is optimized for someone who retires at the target date and cashes out. That is almost nobody. Most people retire a few years before or after the target date and leave most of their money invested. Stephanie's fund will be too conservative for her actual retirement timeline. By the time she is 67, the fund will be 60% bonds. She will have a 20 to 30-year investment horizon remaining. She does not need 60% bonds. She needs maybe 30% bonds. The fund is costing her growth in the final years before retirement and in the early years of retirement because the glide path is designed for a retiree profile that does not match reality. The fund of funds structure is another hidden cost. Target date funds are not actually index funds. They are funds that hold other index funds. Stephanie's Vanguard Target Retirement 2040 fund holds 10 different Vanguard index funds in various allocations. Each of those underlying funds has its own expense ratio. The target date fund charges 0.75% on top of the expense ratios of the funds it holds. You are paying double layers of fees. The underlying funds average 0.05%. The target date wrapper adds 0.7%. If Stephanie just bought the underlying funds directly and rebalanced herself once per year, she would pay 0.05% instead of 0.75%. That is a 0.7% annual savings. On $312,000, that is $2,184 per year. Over 20 years, that is over $43,000 in saved fees, and that does not account for the compound growth of the money not paid in fees. The fund-to-fund structure exists because it is more profitable for the fund company. It does not exist because it benefits you. The rebalancing story is that target date funds automatically rebalance so you do not have to think about it. Rebalancing means selling assets that have grown and buying assets that have lagged to maintain your target allocation. If your target is 70% stocks and 30% bonds, and stocks do well and grow to 75% of your portfolio, you sell 5% of stocks and buy bonds to get back to 70-30. This prevents you from becoming too aggressive. The problem is that rebalancing in a tax-advantaged account like a 401k is free and takes 5 minutes once per year. You log in, you see your allocation, you click a few buttons to sell and buy, done. Stephanie is paying 0.7% per year, $2,100 per year for a service she could do herself in 5 minutes annually. She is paying $42 per minute of rebalancing. Nobody's time is worth $42 per minute for clicking buttons. The automatic rebalancing is not a valuable service. It is a fee extraction mechanism disguised as convenience.
The marketing language around target date funds is designed to make you feel like choosing your own allocation is risky and complicated. The 401k enrollment materials say things like, let the experts handle it, and designed for your time horizon, and reduces risk automatically as you age. This language creates the impression that not using a target date fund means you are taking unnecessary risk, or that managing your own allocation requires expertise you do not have. It is false. Managing your own allocation is not complicated. You decide what percentage stocks and what percentage bonds based on your age and risk tolerance. A common rule is your age in bonds. Stephanie is 47. She could hold 47% bonds if she wanted to be conservative, or she could hold 20% bonds if she's comfortable with more risk, or she could hold 0% bonds because she has 20 years and can ride out volatility. Any of those choices is fine. The decision takes 30 seconds. Then, once per year, you rebalance if your allocation has drifted more than 5%. That is it. You do not need experts. You do not need a target date fund. You need to subtract your age from 100 to get your stock allocation percentage and click a few buttons once per year. Stephanie is paying thousands annually to avoid a task that takes less time than brushing your teeth. The false diversification is another problem. Target date funds hold 10 or 12 different underlying funds to make it look like you are highly diversified. Stephanie's fund holds U.S. stocks, international stocks, U.S. bonds, international bonds, and tips. The diversification looks impressive. It is redundant. The U.S. stock fund and international stock fund are both broad market index funds. Holding both does not reduce risk meaningfully. It increases complexity and fees. The bond funds are also redundant. U.S. bonds and international bonds and tips all serve the same purpose: stable income with low volatility. Holding all three does not make you safer. It makes your fee structure more expensive because now you are paying expense ratios on 3 bond funds instead of 1. Stephanie could get the same diversification by holding 2 funds, a total stock market index fund and a total bond market index fund. 2 funds, 0.04% expense ratio on each. Total cost, 0.04%. Instead, she holds a target date fund that holds 12 funds and charges 0.75%. She is paying 18 times more for fake diversification that does not improve her returns or reduce her risk. The behavior argument is the one defense of target date funds that has any merit. The argument is that target date funds prevent people from making emotional decisions during market crashes. If you are managing your own allocation and the market drops 30%, you might panic and sell everything and lock in losses. The target date fund keeps you invested because you are not looking at individual funds and making decisions. You are just in the target date fund and it stays the course. This argument assumes you are an idiot who cannot handle volatility. Maybe that is true for some people, but if you cannot handle seeing your account balance drop during a crash, you also cannot handle being in a target date fund that drops during a crash. The target date fund does not prevent losses. It just prevents you from seeing the individual fund losses because everything is wrapped in one target date package. If that psychological trick is worth $2,100 per year in fees and $49,000 in underperformance over 12 years, then target date funds are for you. For everyone else, the behavior argument is an expensive excuse to avoid learning basic investing. The transition at retirement is where target date funds completely fail. Stephanie's fund will reach its target allocation in 2040. At that point, the fund will be approximately 60% bonds and 40% stocks. That allocation is designed for someone who is withdrawing their money. But Stephanie is not cashing out in 2040. She is retiring in 2043 and then withdrawing 4% per year. Her money needs to last 30 years. 60% bonds is too conservative for a 30-year investment horizon. She should be closer to 50% stocks, even in retirement, to ensure her portfolio grows enough to outpace inflation. The target date fund does not adjust for the fact that retirement is not a one-time cash-out event. It is a 30-year period where your money is still invested. The fund reaches the target date and then just sits there in a conservative allocation that is not appropriate for most retirees. Stephanie will either need to move her money out of the target date fund at retirement and into a more appropriate allocation, or she will stay in the fund and accept lower returns for the rest of her life. Either way, the fund failed to do what it promised: manage her money appropriately through retirement.
The alternatives are simple and cheaper. Stephanie should be in a total stock market index fund or an S&P 500 index fund until she is 55. 0.04% fees, 100% stocks, maximum growth for the next 8 years. Then, at 55, she shifts 10% to bonds. At 60, she shifts to 20% bonds. At 65, 30% bonds. At 70, 40% bonds. She does this by selling some stock fund shares and buying bond fund shares once every 5 years. 5 minutes of work every 5 years. Total cost over 20 years, maybe $800 in fees. Compare that to target date fund fees of over $75,000. She saves $74,000 in fees. She gets higher returns because she is not holding bonds unnecessarily in her 40s and 50s. She has full control over her allocation and can adjust based on her actual risk tolerance instead of a generic glide path designed for an average retiree who does not exist. The target date fund is not serving her. It is extracting fees and lowering returns while convincing her that she is being responsible. What Stephanie should do now is painful because it requires admitting she has been in the wrong fund for 12 years. She needs to log into her 401k, sell her entire target date fund position, and buy the lowest cost total stock market index fund or S&P 500 index fund available in her plan. If her plan does not offer one, she should buy whatever broad stock index fund has the lowest expense ratio. Then she needs to set a calendar reminder for 5 years from now to shift 10% to bonds. That is it. She will immediately stop paying 0.75% in fees and start paying 0.04. She will immediately stop holding 30% bonds and start holding 100% stocks, which will generate higher returns over the next 8 years before she actually needs to be conservative. The switch takes 10 minutes. It will save her over $70,000 in fees and probably another $50,000 in improved returns over the next 20 years. $120,000 total benefit for 10 minutes of work. That is $720,000 per hour. There is no other task Stephanie can do that pays $720,000 per hour. But she probably won't do it because the target date fund feels safe and changing feels risky. The feeling is wrong. The target date fund is the risky choice because it guarantees underperformance and high fees. The simple index fund is the safe choice because it guarantees low fees and market-matching returns. If you are Stephanie, or if you are in a target date fund because it seemed like the responsible default option, the decision is clear. First, check your 401k and find out what you are actually paying in fees. Look for the expense ratio. If it is over 0.2%, you are overpaying. Target date funds are typically 0.5 to 1%. Index funds are 0.03 to 0.05. The difference compounds to hundreds of thousands over a career. Second, check your asset allocation. If you're more than 10 years from retirement and you're holding more than 20% bonds, you are being too conservative and giving up growth. Bonds are for when you are within 10 years of needing the money. Before that, you should be overwhelmingly in stocks. Third, calculate what the target date fund has cost you. Compare your returns to a simple S&P 500 benchmark over the same period. The difference is what you paid for the convenience of auto-rebalancing and a glide path you do not need. If that number is large, switch out of the target date fund immediately. Fourth, set up your own simple allocation. One stock fund until you are 10 years from retirement. Then start shifting 10% to bonds every few years. This is not complicated. It does not require expertise. It requires 15 minutes of research and 5 minutes of execution every 5 years. Fifth, ignore the 401k provider's marketing materials that push target date funds. They push them because target date funds generate higher fees for the provider. The provider doesn't care about your returns. They care about their revenue. Your job is to care about your returns. Stephanie is 47 with $312,000 in a target date fund. Her coworker has $361,000 in an S&P 500 fund. The difference is $49,000 after 12 years. If they both continue on their current paths for another 20 years until retirement, Stephanie will have approximately $900,000. Her coworker will have $1.2 million. The gap is $300,000. Same contributions, same timeline. $300,000 difference because Stephanie chose the fund with her retirement year in the name, and her coworker chose the fund with the lowest fees and highest stock allocation. Stephanie thought she was being smart by letting experts manage a fund designed for her age. She was being harvested by a fee structure designed to look simple while extracting maximum revenue from people who do not read expense ratios. The target date fund is not optimized for Stephanie's retirement. It is optimized for the fund company's profit. Stephanie is paying for that optimization with $300,000 of her retirement. You can keep sitting in your target date fund because it feels safe and automatic and designed for you, or you can recognize that target date funds are expensive, bond-heavy too early, and structured to benefit fund companies at your expense, and that a simple low-cost stock index fund that you rebalance yourself twice per decade will leave you hundreds of thousands richer at retirement. Stephanie is losing. Her coworker is winning. The difference is not luck or skill. The difference is fees and asset allocation. I've been obsessing over this, so you stop paying for convenience that costs you a third of